Hi, this is a video about stocks and investing in stocks. Give me a second here to get the screen set up here. Whoops, that's not what I want. Okay, all right. So let's talk about stocks here. First of all, what is a stock? It's a piece of paper, a stock certificate saying that you own part of that company. You own a part or share of that company. These days, of course, we don't buy, sell, or hold paper stocks. It's all done electronically on computers, on the web. Here, of course, you see the company that this stock is in, and here you see the QSIP number or identification number. This certifies that, and here's your name. You are the owner of one share of Google. And here are the two founders and heads of Google, Larry Page and Sergey Brin. This is another stock certificate. If you own this stock, what does that mean? It means that you own a little bit of that company. And in this case, it's Netflix. Here is Disney's stock. Disney's stock is famous for this pretty artwork. Disney's motto is where your dreams come true. And how could owning stock help your financial dreams come true? Because as part owner, you're going to make money off of the stock, hopefully. When a company makes money, makes profit, they reinvest some of that profit into the company to develop new products and build new factories, etc. They put some of the money back into the company. They also take some of that profit, some of that pay, and divide it up into a payment to you called a dividend. And you see the root of that word is divide because it's the company's profit divided up and sent out to all those part owners. So this is an example of a dividend check. This is from a while ago. This is 1939. This is the Pennsylvania Railroad Company. And here you see it's $189 worth of dividend. That was a lot of money back in 1939. So these people who got this check, they must have owned quite a bit of stock in the Pennsylvania Railroad Company. Again, you, the stockholder, are part owner, so you get some of the company's profit. In addition to some pay, you also get some say. In other words, you get a voice, a vote in the current management and future direction of the company. For example, you can vote on the company's board of directors who are going to run the company. You can vote in person or send in a proxy ballot. It's like an absentee ballot, and it looks basically like this. This is Research in Motion, known by its initials, RIM. It's a Canadian technology company. And if you remember about 5-10 years ago, they made the BlackBerry. And here you see a proxy ballot. So you could fill this out online if you want James and Mike and James to be on the board of directors and run the company. As part owner, you can attend the annual meeting of shareholders. Here's Disney's 2017 annual meeting. Annual meetings, it's typo, sorry. Annual meetings usually happen in places like Chicago, Denver, Dallas, or Orlando. Why there? Well, Chicago, Denver, and Dallas are basically in the middle of the country, so it's easy for people to travel there. And Orlando, Florida is a nice, warm, sunny place. You can advise the company. After all, it's partly your company. Here is an individual investor right here, this guy right here, he's an individual investor speaking at Coca-Cola's annual meeting. On the screen on the left, this guy right here is Warren Buffett. He's one of the richest people in the United States, and he owns a significant percent of Coke stock. You might own 1 or 2 or 5 or 10 shares. You could stand up and say, I think that next year the company should do A, B, and C. And the people up on the platform will say, thank you very much, Mr. Smith. We will take that into consideration. And they basically ignore you. But if you're someone like Warren Buffett and you own 5% or 15% of Coca Cola, they're going to listen to you. He owns a lot of stock, so he's got a lot of say. How do stocks become available? Well, a company needs to raise money. They don't want to raise money by selling bonds because then they have to pay back that money plus interest. Instead, they choose to raise money by selling stock. The problem with that is that the company loses some control or loses some ownership in exchange for money. So when companies have to raise money, they decide, do we want to sell bonds? Problem with that is we have to pay the money back plus interest. Or do we want to sell stock? The problem with that is we lose some control, we lose some ownership. An investment bank, usually in New York City, some famous ones are Goldman Sachs and JP Morgan, they advise the company on how many shares to sell and at what price. The iBank, the investment bank, might also underwrite or buy those stocks in what is called the initial market, the first market. The company goes public. In other words, it has its initial public offering. And after that, anyone, you, me, a mutual fund, a bank, a company, a Spanish investor, a Japanese investor, anyone can buy parts of the company. What was once a private company is now public. It's publicly owned. There are different types of stock. Blue chip stocks are stocks of big, established, long-time companies. Examples include Nike and McDonald's. Growth stocks are stocks of smaller, newer companies that are expected to grow a lot. Penny stocks are lower price stocks. You have stocks in American companies, stocks in Japanese companies, French companies, etc. More on that soon. And stocks also differ by the size of the company. This is also known as market capitalization. What is market capitalization? It's the number of stock shares that exist multiplied by the price of each share. Here's a simple example. Let's say 100 shares of Apple stock exist. Each share sells for $10. Apple's market capitalization, or market cap, is 100, the 100 shares that exist, times $10 each is $1,000. In other words, Apple has raised $1,000 of capital, $1,000 of invested money. In other words, Apple, the company, is worth $1,000. Here's a realistic example. Roughly 4 billion shares of Apple stock exist. Each one sells for about $300 because there are a lot of people out there who would like to own a little part of Apple. So Apple's market cap is 4 billion, the number of shares, times $300, price per share, equals about $1.2 trillion. That's a big company. Stocks are often described by their market cap. For example, large cap stocks have a market cap greater than $10 billion, and you've heard of many of these large cap stocks. These are just some of them. Mid cap stocks have a market cap between $2 and $10 billion. Tesla, Foot Locker, the sneaker store, Scotts Miracle-Gro sells that product that makes your lawn nice and green. Small cap stocks have a market cap of less than $2 billion. Most small cap stocks you have not heard of, but I tried to find some examples that maybe you have heard of. Where are stocks traded? In other words, where are they bought and sold? On stock exchanges. Here's some old examples. This is Amsterdam and Holland in the 1600s. Hey Lars, would you like to own my share of the Dutch East India Company for 12 guilders? Sure, Marcus, let's trade. And they would exchange that stock certificate for money. In the United States, the first stock exchange was very informal. It was under the so-called buttonwood tree on Wall Street in New York City, downtown in Manhattan. Wall Street is where the New York Stock Exchange is located. This is the building, and on the inside you have the trading floor. Here you see this is the place where they trade Johnson & Johnson stock. The NASDAQ is another important stock exchange. It's located at Times Square in Manhattan in New York City, and many of the newer and technology stocks trade on the NASDAQ. In other words, that's where you go to buy and sell them. But these days, trading is done electronically via computer and on the web. These are the trading desks, the trading floors at the major banks like Goldman Sachs and JP Morgan. So these are people buying and selling stocks or buying and selling bonds. People in the financial industry use what are called Bloomberg terminals because they provide financial information and news in a fast, clear way. And they cost about $25,000 a year to rent. And this is how Michael Bloomberg made a lot of money. He started this company, provided these terminals. He became a billionaire, and he became mayor of New York City and briefly ran for president. Do you understand what this Bloomberg screen is showing? If you look here, you see this is the federal funds rate, okay, the overnight rate that banks charge each other for short-term loans. Here's information on U.S. T-bills, these short-term U.S. government bonds. Here's the Dow Jones. We'll talk about that. It's a list of 30 major U.S. companies. Here's information on U.S. bonds. This is if you want to buy and exchange a foreign currency like Japanese yen or euros or Great British pounds. Okay. This is the NASDAQ, another stock exchange. Here's some interest rates. Okay, here's what the price of gold is selling for. This is the major news statistics that are coming out soon. So the Bloomberg terminal gives you a lot of information very quickly. All right, do I want to invest in stocks? Well, let's consider the costs and benefits. Start with what are the differences between bonds and stocks? A bond is debt, it's a loan. A stock is a piece or share of ownership. If you buy a bond, you're a lender. If you buy a stock, you're an owner. If you buy bonds, you lend to companies or governments. If you buy stocks, you own part of a company. Bondholders can make money in two ways. They can collect annual interest, or they can buy low and sell high. Stockholders can make money in two ways. They can collect quarterly dividend, it's 4 times a year, or they can buy their stock low and sell it high. Bonds are considered safe-ish because the borrower is bound, they're bonded, they're required to pay you back. Stocks are considered riskier because the company you partly own might decline or die. Bonds usually grow about 4% a year. Stocks grow about 6% a year. How does stocks growth compare to other assets? Does investing in stocks pay off in the long run? Well, let's look at the last 200 years, going all the way back to 1800 when Thomas Jefferson was president. Which asset classes performed the best? And you can see here, it's stocks. If you had invested $10,000 in Thomas Jefferson's day, it would have grown to be $5 million today. Bonds grow a lot, but not as much as stocks. If you had just sat in cash and put your money in the sock drawer, your money would have lost value. Why? Because of inflation. What's inflation? It's rising prices. Even if you won't live for centuries, none of us will live 200 years, stocks are still a good investment. Let's look at the last 50 years from 1965 to 2014, and let's see how much $1 would have grown. $1 would have grown to about $100, okay, in stocks. In bonds, it would have grown to about $24. That's still a big investment. So if your grandparents had saved money then, it'd be worth a lot more today. Let's say you lived in the 1960s and you spent $10 on marijuana. You could have invested that $10 in stocks and it would have grown to how much money? It would have grown about 100-fold. So that $10 would be about $1,000. So the pot, the marijuana, didn't just cost you $10. It cost you $10 plus worse health, plus higher health bills, plus the $1,000 that you missed out on. Your money could have grown tenfold. So please do not do drugs. It's a waste of time, it's a waste of your health, and it's a waste of money. Okay, what are the costs of? What are the problems with stocks? Stocks are also known as equities. Equities means ownership. Stocks fluctuate. In other words, they increase in value. They go up and down in value. They sometimes have a lot of volatility. In other words, they go up and down. You might buy a stock for $10 and it might drop to $7. It might go up to $13. It might not. Are you okay with that risk? Second, if your company dies, who gets paid off first in case of bankruptcy? The bondholders do because they loaned money. So this is known as the capital stack. And in other words, if the company dies or goes bankrupt, the first people to get paid back are the bondholders here, and the last people to get any money back are the equity holders, the stockholders. Another problem with stocks is that it's very difficult to decide which stocks to buy. When you buy something to own, such as a car or a home or stock, do you want to pay a high price for low quality? No, that would be bad value. Or do you want to pay a low price for high quality? Yes, that'd be a good value. Of course, we want to pay a low price for high quality. Determining a stock's price is easy. Just look on the web. One piece or one share of Coca-Cola stock has a price of $240. That's really easy to find. But is buying Coke stock a good value? Is that price too high or too low? That's very hard to determine. So to pick a stock, first do a financial analysis. Step one, you want to look at earnings per share, EPS. Earnings are the money that's left over after the company has paid its expenses and taxes. So earnings per share is a measure of profit. The formula is to take the net income, the earnings, and divide it by the number of stock shares outstanding, all the stock shares that exist, and that gives you your EPS. Here's an example. Whose stock should you buy? Company A or Company B? Company A is $100 in income divided by the 10 shares that exist. 100 divided by 10, that's going to give you an EPS of $10. Company B has $10 of profit divided by 100 shares that exist in that company. 10 divided by 100 is 1/10, or an earnings per share of 10 cents. Which stock would you rather own? Of course, you'd want to buy Company A's stock. It earns more money per share, $10 of earnings compared to 10 cents. You want your earnings per share to be a high number. Why? It means that for each share, for each part of the company you own, the company is earning a lot of money. Financial analysis step two, you've got to look at the price to earnings ratio. It's called the PE. It's a measure of a stock's value. Is the stock underpriced and so a good value for you to buy? Or is the stock overpriced and so a bad value for you to buy? The formula is the stock price divided by earnings per share. Here's an example. Whose stock do you want to buy? Company A or Company B? Company A is a $10 stock price divided by an earnings per share of $100. So that's $10 stock divided by 100, that's 0.1. Company B has a $100 stock price, pretty expensive, and only $10 earnings per share. So that's 100 divided by 10, that's 10. Of course, you'd want to buy company's A stock because with company A, you're getting more earnings for a lower price. You're getting $100 worth of earnings for $10. Company B, you're paying $100 for only $10 of earnings. Company A is obviously a better value. You want the PE ratio to be low. Why? It means you're paying a low price for a lot of earnings. Remember, a large denominator, large earnings at the bottom of the fraction, and a small numerator, small price, is going to give you a low number. Financial analysis continued. Also look at the earnings yield, the price to book ratio, the price to sales ratio, free cash flow, and other statistics. And that's just a financial analysis. You also have to do a product analysis. Are the company's products selling well? And you have to do a market analysis. What does the future demand look like? And you have to look at the company's management, and you have to look at changes over time. You also have to do that for the competition. After all, you can't decide to buy Coke stock without also looking at Pepsi stock, right? All of that takes a lot of time. And even if you do all the analysis properly and find a stock that's a good value, that is, it's a low stock price and a great company, if other investors disagree with you and they don't like the stock, sorry, that's a typo, then the stock's price falls and you lose money. So you could do all this homework, do it all right, find a good buy, but if other people disagree with you, they're going to sell the stock. The stock price is going to go down. You're going to lose money. Do you really want to spend your weekends filling out charts like these? Apple versus Samsung, earnings per share, earnings yield, price to book ratio, debt to equity. And you also have to do your taxes on the weekend. No, you don't want to spend your time doing this. And some of the most respected companies, such as General Electric and Hewlett Packard. General Electric makes refrigerators, stoves, washers, dryers, airplane engines. Incredibly respected company. Hewlett Packard made computers, makes printers, incredibly respected. For decades, they were considered great stocks, but they have declined a lot and lost money recently. All right, so how should I invest in stocks and get the benefits without the costs? First, you want to save 6 to 9 to 12 months worth of emergency savings in a money market fund. Remember, that's an account that lends your money out for a very short period, like 30 days, and pays you a pretty good interest rate. Or you could put your money in a certificate of deposit. Then, with your long-term savings, practice the rule of 100. The rule of 100 is you take 100, you subtract your age, and that's the percent of your long-term savings that should be in stocks. Your age is the percent of your long-term savings that should be in bonds. For example, you guys are roughly 20, so subtract 100 minus 20 and you get 80. 80% of your money should be in stocks, that is equity. 20% of your money should be in fixed income, that is bonds. How should I invest in stocks? Invest in mutual funds. They offer diversification. In other words, they spread out your money over many investments. There's a professional money manager managing your money, and they have lower costs than you doing it individually. Do not use apps or platforms such as E-Trade or Robinhood. Often they will charge you for every transaction you do. And Robinhood has had some problems recently because the platform has crashed and people have wanted to sell or buy and they can't at that moment. And also, they don't offer every single stock or bond. Instead, you want to invest in Vanguard or Fidelity mutual funds that are more than 5 years old and run by experienced managers. Why? So that both the fund and the manager have experienced bull markets, that's when markets rise, those are good times, and bear markets, that's when markets fall, those are bad times. You want to invest in mutual funds that have an expense ratio of less than 1%. So if you gave them $100 of your money, they would take less than $1 in management fees. And also, you invest in mutual funds that are diversified. Again, they've spread out your money. Two of the most respected mutual fund companies are Vanguard, they're headquartered outside Philadelphia, and Fidelity. And Fidelity happens to be in downtown Boston. If you work in the financial industry, like this young man at about 25, you'd work in a cubicle called a cube, and you would support the fund managers, like these two people. And they're deciding which stocks to buy for the fund, at what price, and how many, and how long do we hold on to those stocks. If you diversify with mutual funds, a few of your stocks will fall, but most of them will rise over time. Why? What makes stocks to go up and down? Well, one of the things is weather. What would a bad hurricane season in the Caribbean do to the stocks of companies that offer cruise lines? If there are a lot of hurricanes in the fall in the Caribbean, that's going to hurt cruises. So cruise stocks would go down. What about a war? If war starts in the Middle East and gas pipelines are blown up, what's going to happen to the stock of oil companies like ExxonMobil? The stock's going to go down. Why? There's less gas, they're making less money. Competition. If Apple comes out with a great new product, what happens to Samsung stock? It'll go down. Why? People are using the competition. There could be a product problem. If Samsung Galaxy phones catch fire, which happened a couple years ago, what happens to Apple's stock? It goes up. Why? There's a problem with the competition. Also, there's news. If unemployment goes up and people don't have jobs, what happens to the stock market? It goes down. Why? People don't have jobs, they don't have as much money to spend, companies don't earn as much money, people don't want to buy the stocks. Or if Nike reports that it didn't earn as much as it expected to last quarter, that is the last 3 months, what'll happen to Adidas stock? It'll go up. Why? The competition isn't doing as well. Elections can change stocks and bonds. The deaths of politicians or company leaders. For example, Steve Jobs started Apple and came out with all these great products, and he died a couple years ago. And now the question is, will Apple continue to innovate and make great products? In general, a bull market is when stock prices go up, the economy is growing, it's easy to make money. And a bear market is when stock prices go down, the economy is shrinking, and those are bad times. If you are bullish, you are optimistic, you think stocks will rise in price. If you are bearish, you are pessimistic, you think stocks will fall in price. You also need to understand stock news. In the 1880s, Charles Dow and Edward Jones started a company. They called it Dow Jones. And they published a newspaper, the Wall Street Journal, so investors would have honest reporting. Because back then, most financial information was railroad companies saying, buy our stock, our company's great, and it's growing. Well, was that true? Investors didn't have a neutral third party, so Dow and Jones started the Wall Street Journal. Today, the journal is highly respected and a main source of information for people in business and finance. One place you should get your news is wallstreetjournal.com. Here's the homepage. Okay, other great sources for financial and business news are Bloomberg website. The Economist is a weekly magazine and a website, and the Financial Times is a English newspaper. Dow and Jones made up 100 years ago an average of 12 stocks of 12 big important companies from 12 different industries. Why? To quickly get a snapshot or overview of how the economy is doing. Here are the original 12. General Electric, okay, which is still around, and an oil company, sugar, tobacco company, cattle feed, a coal company, leather, rubber, that sort of thing. This is the original 12. Today's Dow Jones Industrial Average are these 30 companies, and they give us a snapshot of the economy as a whole. So we talk about the Dow Jones going up or the Dow Jones going down yesterday. That means these 30 companies on average did better or did worse. It's a snapshot, it's a profile, it's an overview of the economy as a whole. All right. And you'll recognize almost all of these companies and what they do. Apple, of course, tech. Boeing makes airplanes. Coke represents the beverage industry. ExxonMobil gas. McDonald's sells death. Nike apparel. Walmart is retail stores. Walt Disney. So this is a wide look at the economy. What does this news headline mean? The Dow was up 455 points. Here it is, or 1.9% yesterday. All right. What does that mean? Well, here is the average. The average of those stock prices of these 30 companies, the average comes to about 24,331. Okay. Back in May 2020. Okay. And yesterday, the average went up by about 455 points, or almost 2%. So this is what happens. And you see stocks go up and down, but over time, they tend to go up. And we'll talk about what that means for you and how you can make money off that. There are several major indices. That's the plural of an index. What is an index? It's a list of stocks. The Dow Jones Industrial Average, we just talked about it. That's 30 big stocks representing 30 different industries. Why? To get a quick, abbreviated snapshot and overview of the economy. But it's only 30 companies. So Standard & Poor's is another company, a financial news company, and they put together the Standard & Poor's 500. That's the 500 largest U.S. companies by market cap. The Russell 2000 is another index. It's a list of 2,000 small cap stocks. Why do investors look at the Dow Jones and the S&P 500 and the Russell? Because it gives them different looks at the economy. This is 30 huge, famous, big companies. This is 500 of the largest companies, a little bit larger. And the Russell also includes some small companies, not tiny companies, but small. You also have foreign stock indices that you want to follow. Should you invest in foreign stocks also, or just US stocks? You also want to invest in foreign stocks. Why? Sometimes the US economy goes down and other economies go up. This is the London Stock Exchange in London, England. And investors watch the FTSE 100. It's pronounced FTSE, the FTSE 100 index. This stands for Financial Times Stock Exchange. The Financial Times is a British newspaper, and it makes this FTSE index, kind of a funny name. And that includes these famous companies that you've heard of. British Petroleum is gas, Burberry, Rolls-Royce, Shell, Unilever is one of the world's largest food companies in the world after the Swiss company Nestle. This is the Paris Stock Exchange, okay? La Bourse, which means the purse in French. Investors watch the CAC 40. That's the French index. It includes Danone, which we know as Danone. It's a huge dairy company. L'Oreal, one of the largest cosmetic companies. And you can recognize some of these others. Germany's stock exchange is called the DAX. It's in Frankfurt, and you can recognize these companies. The Tokyo Stock Exchange. Investors watch Japan's Nikkei 225. That's the leading Japanese index or list. Nikkei is a newspaper, and it makes this index or list of 225 stocks. Which companies are in the Nikkei 225? You've heard of a lot of these companies. All right, now we're ready to pick a stock mutual fund, and I will prepare another video for that. If you have any questions, please let me know.